So I'm going to give quite a boring answer to this because the strategy and positioning has remained pretty consistent for a long period of time. It is still about partnering with a group of private equity managers we consider to be amongst the market leaders. We principally do that in Europe and in the mid-market. And we do that through investing into their funds, but also directly alongside them into private companies through co-investments as well. So it's been a pretty stable strategy for over 2 decades. We don't try and market time. We try and have a consistent level of deployment across the various different years. But yeah, maybe the key thing and the key development over the last few years has been the development of co-investments. We introduced co-investments to the investment objective back in 2019, and that's grown now to around 19% of the portfolio, with 22 underlying co-investments in the portfolio level. That compares to 2021 when co-investment was around 11% of the book and 13 co-investments. Well, we've just announced our financial year 2022 results, and our financial year runs to the 30th of September. And in the year, NAV continued to grow, as it has done since 2010. So it grew by 14.1% during the year. And we're really proud of that performance of what's been a difficult year overall in financial markets. And that compares with the Trust's comparative index, the FTSE All-Share, which declined 4% in the year. And this means now that our annualized NAV total return since inception is 11.7%. On an annualized basis. So strong performance over the long term and through the cycle, which we're pleased about. What we're less pleased about is the share price performance during the year. Now, the private equity sector had a tough year in terms of share price performance. So most trusts declined by a similar amount during the period. But our trust declined 15.1% during the year. And that means that the discount, the share price discount to NAV has increased to just over 40% at the 30th of September 2022. If we look at our new investment activity, we've deployed just over 340 million sterling into new investments, to 12 primary fund commitments, to 2 secondary transactions, to 9 co-investments and 1 follow-on investment in an existing co-investment. So strong deployment through the year. In addition, we received a record level of cash distributions back from our portfolio during 2022. So it was around 210 million sterling. But in addition, we made 2 secondary sales from our portfolio, which contributed an additional 15.7 million of proceeds during that period. Aside from that, our outstanding commitments are just shy of 680 million sterling at 30th of September 2022. This translates to an overcommitment ratio just below 40%, which is at the lower end of our target range of 30% to 75%. And in terms of balance sheet, we feel pretty good about the position we're in at the moment, especially given the fact that we increased our revolving credit facility from 200 million to 300 million during 2023. So as I've mentioned, our strategy has been pretty consistent over a long period of time. So if we think about the key portfolio changes, I would call out the co-investment strategy. So we introduced co-investments in 2019, and it was a very obvious step for us to make, given we had a co-investment team in place of 7 investment professionals that had been making co-investments in some of our other client mandates for some time. And this portfolio has grown from nothing to 19% of the book at 30th of September 2022. That corresponds to 22 individual co-investments. And if we compare that to 2021, the co-investments were around 11% of the book and 13 individual co-investments at that time. So strong growth, and we continue to expect it to grow to around 25% of the book and a portfolio of around 30 co-investments over the medium term. So the first holding I talk about is a new co-investment we made during the year, which is a business called NGE. And this is an infrastructure services business. It specializes in infrastructure projects relating to railways or water networks or buildings or civil engineering. And it's a business that we partnered with Montefiore Investment, who we consider to be one of the strongest private equity players in France. So very excited to partner with Montefiore there. And the opportunity is quite abundant, actually, because you've got a very strong management team at NGE, and they have a very, very strong position in France. And France right now has a lot of infrastructure activity, and they're hosting a great deal of events on a global scale in the near future. So, for example, the Rugby World Cup or the 2024 Olympics. But in addition, the Paris metro system is being revamped as well. So there's an awful lot of infrastructure activity right now in the country. But we think one of the biggest opportunities here is actually expanding this business more internationally. I think there's a really strong angle for this business as it moves across Europe and further afield. So that's another opportunity as well. And we also view this business as somewhat of a sustainability innovator or leader in the infrastructure sector. So that's another area that further value could be created over our holding period. In addition to NGE, I maybe call out a secondary investment that we made. It's a project called Project Ivy, and it really related to a secondary process where there was another investor looking to sell a large, eclectic private markets book. And what we were able to do was able to carve out 3 particular fund interests from that very large book, relating to 3 core managers that are in APO. And we knew that these managers were quite hesitant and picky with who they allow their fund positions to be transferred to. So we're able to carve out that opportunity. And because we've done diligence on these managers and these funds so recently through our primary investment due diligence, we had a really strong angle in terms of this transaction. And what was even more pleasing is we were able to secure these particular fund interests at a discount to their carrying value. So that was another appealing part of this particular transaction. So the first thing I would say is, and reiterate, is that we don't try and market time. Our view, and it's slightly cliched, is that money tends to flow into private equity at the wrong time, i.e. at the height of the market, and flow out of private equity at the wrong time, near cyclical troughs. So we try to stay consistently invested throughout the cycle so you can take advantage of the best investment returns. And so to that end, when we look at our primary fund commitments that we're looking to make, nothing's really changed. We're backing or we're aiming to back some of the leading private equity managers, principally in Europe and principally in the mid-market. Typically more towards the lower end of the mid-market, as we recognize there's been a lot of capital raised at the larger end of the private equity spectrum. And we think that, the lower mid-market, where competition is less institutionalized, where there's a lot of value creation opportunity, and there's an opportunity upon exit to sell into the well-capitalized large segment of private equity, or indeed to a trade buyer or IPO, makes that segment very appealing. But in addition to that, we are looking to back more and more sector specialists. We think having that sector expertise, knowing a sector, an inch wide, a mile deep, so to speak, is going to be critical in terms of success and differentiation in the next decade of private equity. So more sector specialists, more lower mid-market funds on the primary basis, but a very consistent deployment year on year. And if we look at co-investment, as I alluded to earlier, we expect co-investment to continue to grow from 19% now to maybe around 25% over the medium term, and a portfolio of 30 co-investments in total. So we'd expect that to continue to grow with a pretty balanced view on sector, try and build a co-investment portfolio with a very similar sector exposure to the wider book. Healthcare and tech at the forefront, but pretty well balanced beyond that across consumer, industrials, financials, and the like. The main area I think there might be an opportunity, and it remains to be seen somewhat, but secondary investment in times of volatility and uncertainty tends to throw up a great deal of deal flow, as there's a lot of investors looking to rebalance their portfolio because of the denominator effect, i.e. they're their listed portfolio has declined more than their private markets book, and they need to rebalance that through the secondary market. Or indeed, there might be investors that have liquidity issues and need to sell for that reason. So we think and expect there to be a bit more deal flow in terms of secondaries in the marketplace, and that'll be an opportunity for our team of 8 secondary investment professionals to take advantage of.